Good evening, traders from across the globe, and welcome to the 873rd edition of Short-Term Trading Live with Oscar Carboni, and that would be me. Traders, I'm heading into my 30th year. I'm already into my 30th year this year of analyzing markets, trading those markets, and using the analysis to figure out where markets are going to go next. As we know, technical analysis doesn't always work well, and futures trading can be extremely risky, can cause substantial financial loss, and is certainly not suitable for all trading accounts. But for you traders that understand the risks, that know what's going on, that know that a stop is your best friend, let's get going, traders, because we got a lot to speak about in this video. Right off the bat, I'd like to say this video is being filmed on Wednesday night for Trading Thursday. That would be May 31st, 2012. Traders, there is a red OMNI on the board. There are bear flags all over markets right now. The ES or the emini S&P, the NASDAQ, the DAX, in the grain market, soybeans. In fact, there are bear markets all over charts, and many of those charts are heading towards the 200 bar moving average. We are going to look at many charts this evening that depict what's going on around the 200 bar moving average. Traders, these bear flags that are all over the US indices and all over a lot of other commodities charts, these bear flags should bear fruit as long as we stay with them. What we've been seeing for the last few days inside of the bear flags, we've had the market go up, down, and it's tricky until it finally breaks out of the bear flag. We need to stay with those bear flags until they begin to bear fruit. And we will do that, and I will show you some charts to depict that as well. Traders, the crude oil, longer term view now. The crude oil is absolutely a long-term stimulus package for the entire planet. Crude oil breaking from the high of 110 and change just a couple of months ago all the way down to the mid-80s. We traded 87 and change today, and it's moving lower. The crude oil breaking that low is absolutely a worldwide stimulus package. There is no better way to get money into the hands of every business, every government, and every individual on this planet. If you make the price of energy cheaper, that is the best way to do it and the fastest. So, come fourth quarter, I think we get to see some benefit from the long-term crude oil stimulus package. However, for short-term trading, bear flags are on the board. These bear flags should bear fruit as long as we stay with them. And the 200 bar moving average is absolutely acting like a magnet, which is pulling the markets down. And you will see U.S. indices come and kiss at least the 200 bar moving average, if not break those and continue lower. Remember, we know for sure that there is a seasonal tendency for the markets, the indices markets, ES, NASDAQ, you name it, to break lower from the month of May through the summertime into August. We are absolutely seeing that. Bear flags are starting to repeat themselves over and over on the indices charts and other charts, pointing us right towards the 200 bar moving averages. And we will take a look at many charts that will show you what's going on there. Traders, there's a whole other thing that's taking place in our markets, and I would like to start a campaign with this video. Many of you, I think, have been fans of this Dodd-Frank Act, which stops banks from prop trading. I do not think you understand what you have done, Congress, senators, many of you that make rules and laws for us traders but never traded a damn thing in your lives. Many of you are supporting a bill that's stopping banks from prop trading. But there is a big thing that goes on when you stop banks from prop trading. It is very simple, traders. If you had a floor full of traders in a pit, those traders that are in the pit, anytime a big entity steps up and wants to trade, I don't care if it's one lot or 10,000 lots, there is liquidity in the pit. There are market makers in the pit. They give bids and offers, the volume flies. That's what it looks like in a normal market. Then you take the Dodd-Frank Act and you tell banks that they can't prop trade, and what do? You pull out the middlemen, you pull out the market makers, you took the locals out of the pit, you took the liquidity out of the market. This is what we're left with. You congressmen and senators that think it's right to stop banks from prop trading, look at what you've done. You've turned our markets into skeletons. You have fed guys like us to the dogs. Don't you realize you've gotten this wrong? You think you're protecting us by stopping banks from prop trading, but that is not protecting us. You are distorting our markets. You have left the guys like us, the honest traders out there trying to survive each day, with this empty liquidity. Now when these HFT, high frequency traders, step in, they can slap this market up or down. There are no banks in there to absorb the liquidity. I assure you that you had good intentions when you tried to take the prop trading from banks, but on the other side of it, I guess I have to start a campaign. I implore you to take another look at this again, because I do not think you realize what you've done. This is a skeleton market. It is a skeleton of what we had just several months ago. Understand, if I have not explained it to you properly, it used to be a day where this solid liquidity was in the market. If a big entity came in, I don't care if it's a hedge fund, I don't care if it's a big company with a problem, anyone that needed to enter the market came in, and the banks were always moving big portions in and out. They're able to absorb anything that comes in. So, big order hits the pit or hits the electronic market, there is no difference. The banks would be like the locals. The banks would be the liquidity providers and the market makers. Their prop trading gets us in and out of our trades. It keeps order throughout the day. You have removed them from the market. You've left us this. You literally are leaving us guys to pick each other's pockets. You need to allow banks to prop trade. You have removed the liquidity and the market makers from our markets. Haven't you noticed now the markets don't seem to have rhyme or reason? They might be going down for half the day. They turn around and shoot up and make a new high, and then the next day go right back down again. Or they go up today, down tomorrow, up the next day, down the next, without much rhyme or reason. Because you've taken the meat of the markets and you've told them they're not allowed to trade. The market makers, the liquidity providers. Incorrect. Needs to be rethought. I would love an invitation to Congress. I would sit down with you senators and explain to you where you've gotten this right and where you are going wrong. But to leave us in the shadow or in that skeleton of a market and allow us to expect us to survive, you have done us an injustice. We need to allow these banks to create the liquidity. Please rethink what you've done. Call Oscar to Washington. Allow me to sit with you. Call on some experts. I assume you just did not think it through when you thought you were going to protect us by stopping banks from prop trading. This is the beginning of a campaign that I'm going to go on. I hope my omniacs out there help me. Contact senators. Contact your congressmen. You need to understand whether you thought it was a good idea or not. And I'm speaking directly to my traders now. It is not a good idea to create a skeleton pit out of what was thriving liquidity. I assure you, by pulling out the banks, that is what's been accomplished. All right, traders, enough of that. With no further ado, let's go look at some charts. Okay, traders, we'll start off with the grains and the bear flags and the 200 bar moving average. Let's start off with soybeans. You are looking at July, soybeans, the daily bar chart, 200 bar moving average down here. Bear flag, what happens? The market breaks down, makes a secondary bear flag. This market is bearish. Soybeans are being dragged down at least to the 200 bar moving average. Expect beans to work their way lower on the daily graph. Traders, there are more grains, of course, that will show you what's going on. Look at the corn. The corn has been below the 200 bar after 3 unsuccessful tests trying to get above. The market finally begins to break. The corn looks like it has a lot lower to go. Then you look at something like the oats. Most people do not recognize this, but the oats is the silent leader of the grains. Oats fails at the 200 bar moving average, and look at this mad dash lower. That is what our soybeans market is doing right now. It is about to head down to the 200 and probably will break lower. What is giving us reason to think the grains will continue, especially soybeans, for trading on Thursday? That would be May 31st, 2012. The CRB index. Look, it's been in this parallel channel working its way down for quite some time. This is the daily. Breaks out of the red channel and creates a new channel, steeper now, heading down. The daily looks great for the downside on the CRB. Great argument for the grains, especially for the soybeans, following the CRB down. Then look at this, traders. Here's the CRB on a weekly graph. Look at how much it's come down already. Thank you to the bullish US dollar. It's about to break the 200 bar moving average. It's broken a major support line. It's now testing the 200 bar moving average. The likelihood is it will get below that 200 bar moving average, and that moving average is all over our charts recently. Let's continue to look further. This is our argument for why soybeans look bearish for trading on the 31st of May. That would be Thursday. Now let's move to the financials. This market has reclaimed its leadership in U.S. indices over the past 2 weeks, and it is the Dow Jones Transportation Average. This is the 200 bar moving average on the daily bar chart of the tranny. You can see big bear flag, unmistakable big bear flag. The likelihood is that we go back to the 200 bar moving average, break that, and continue lower. Your leader is pointing straight down at this point. The DAX traders, shoulder, head, shoulder, big head and shoulders, looking bearish, goes into a bear flag. That bear flag breaks down into a second bear flag. As of trading on Wednesday, you've settled below the bear flag, giving us cause to expect lower in the DAX. That is your leader out of Europe. You just seen the leader out of the US. Your two leaders are pointing towards the ES tomorrow, heading down, traders. Unmistakable formation, the bear flag. You cannot mistake that. Almost perfectly symmetrical here in the emini S&P. This market augurs for lower. It will follow its leaders. Look at the S&P once again. The 200 bar moving average, traders. That is the target. That is where these markets are heading towards, the 200 bar moving average. Right now it's 1274 in your emini S&P. It will likely reach that goal very shortly. So there is the pull that I was mentioning, a magnet, so to speak. We should head down towards that 200 bar moving average. But let's look, because the argument gets better. Here we are looking at the NASDAQ daily bar chart. Bear flag, looks like it's about to be broken. Here is your 200 bar moving average sitting all the way in the 24-28 zone. That is a full 100 points lower than where we are now. This flag looks bearish. This target looks like it's going to be hit. That is what we are expecting in your NASDAQ. But let's continue to look at other charts here. Traders, the next chart on the block for you is the dollar index. What is keeping our NASDAQ and E-mini S&P on the defensive? Look at how strong the dollar index has been. This is now a weekly bar chart. We have stepped out from the dailies and we are looking at a weekly. The dollar had this high level, came off, came back up near it, couldn't best it, came back down, came back up to that high level, came back down. Third time it is now above that level and looks like it will continue on. So your dollar index on the weekly has broken out. It is inside of this new channel right here. This channel will likely be touched. It is all the way in the 85-86 area. That is your US dollar index. What else is keeping the indices on the defensive? The 30-year T-bonds, traders. Look at this chart for a moment. Just take a look at it. I'll be silent for a moment. You look at this chart. Here we are. This trend line goes back to 1981. I know you can only see 84 here, but it starts in 1981. Has not been broken at all the way until today, 2012. This is a perfect parallel of that bottom trend line, a perfect parallel. Traders, it got above it once and came back down. Got above it a second time and came back down. Do you know what they say about 3 times? 3 times a charm. We are above it now. This is the highest I've ever seen bonds in my entire 30-year career. These bonds are breaking out now of a long channel that dates all the way back to 1981. And it looks like bonds will just continue higher, putting pressure on our U.S. indices. That is the short-term picture. That is for trading through the end of May 31st, 2012. Traders, but let's step this out one more time. Now we're looking at a monthly bond chart, right? It's about as far as you can step things. But let's look at what should happen as we come to the end of the summer and we head into the 4th quarter of 2012. Okay, traders, here it is. The longer term view is you are looking at one of the best stimulus packages on the planet. This is crude oil in a smash down, ferocious breakdown, which is just continuing. Crude was at 110.55 just a short time ago. It is now trading in the 87 area. It looks like it's going to come all the way down to about 78. This is the best stimulus package the world could see. Nothing better than cheap energy. It helps every company on the planet. It helps every individual that uses petrol on the planet. It is good for the economy. Then what else is working in our favor? The very same thing that helped the United States get on its feet when we started running into trouble a couple of years back. We lowered our dollar. Thank you, Fed. Lowered the dollar as quickly as it could. Lowered our interest rates. That has been helping us to get back on our feet. Of course, the QE1 and QE2 was there. But one of the key things was we lowered our currency and we lowered our interest rates. Europe, of course, being almost 2 years behind us, behind the 8 ball, is finally beginning to enjoy the same thing, traders. This is the euro. Look at it finally getting what it needs. It needs to be cheaper. The cheaper the euro and the lower the interest rates, the quicker Europe will get back on its horse. This euro long-term decline is very, very constructive for European economy and its recovery process. We expected 122 in euro. It's almost there now. That call was made when we were in the 130s. My Omniacs knew that that's what we were looking for. Here it is now showing up. This will help, just like the crude oil, going into the 4th quarter of 2012, another stimulus package. This one should help Europe. The crude oil should help the entire planet. And I think we should have a strong 4th quarter. That is the long-term view, but as you know, we are day traders, and our short-term view stands as is. We have bear flags. These bear flags must bear fruit. As long as we stay with them, we will catch the downside. So traders, there's my argument for why the bear flags should absolutely bear fruit. We just need to stay with them and stay short as they come down. And the 200 ball moving average is acting like a magnet, but do not forget, as the year progresses and we come out of the summer into the fall, I think the crude oil longer term stimulus package and the euro helping Europe by going lower will show us some bright side and send us towards that target. For trading on Thursday, however, we are looking for the bear flags. We are looking for the red omni, and traders, do not forget, think about what I was saying to you. Think about contacting your senators and your congressmen, because whether you thought it was a good idea or not to take the banks out of this equation, we are left now trying to fight off the high-frequency traders. The hedge fund managers have nobody else but each other to fight with. That's not what they need. They don't all need to be on the same side of any trade. They need market makers in between so no one knows what fund manager is long what and short whatever. What they've done now is removed our liquidity, removed our market makers. This is not how a market functions. Please do something about it. Until then, a lot of stops are going to get hit. A lot of whipsawing is going to take place. And frankly, this is not the way markets were supposed to react. That's why we had such thick volume. That's why the banks have always been part of this mess. All right, traders, enough of that. Remember that the charts are bringing us the bear flags. They should bear fruit. The 200 bar moving average is what we're going to visit in those U.S. indices. And then let's think longer term. After the summer's over, we'll deal with that. Traders, I hope this video is helping to keep you in tune with markets and the analysis behind charts, because that is the best market gauge I've ever come up with in my 30 years. It doesn't work every day, but it is the best gauge I've ever used. It is called technical analysis. All right, traders, for you Omni campers out there, rock and roll. Omni camp starts June 8th. You got, I don't know, what is this, to the end of the month? You guys got 8 days. Make sure that you get in early. Come in on Thursday. Do not try to show up Friday morning. Make sure you get in at least on Thursday night. We'll talk more Omni campers. Don't you worry about it. We'll do some videos in between now and then. But I'm psyched to meet all you guys here in Vegas. All right, traders, come on down to livewithoscar.com. Come into my free trading rooms and don't trade alone. Allow me to help you navigate through these rough and tumble markets. We'll try to get through it together. All right, traders, I hope to see you at the site. Remember, always keep your emotions out of trading. One of the best things you can do to help yourselves with that is say this to yourselves every morning, every afternoon, every evening. And you know what that is. Stops are in. Emotions are out. The bear flags are flying. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided.